think we looked at mergers and then acquisitions or restructuring. Then we also ended with corporate income taxation. That for companies, if you are a company, then for you, you will not pay tax at a graduated rate. You only pay tax at the marginal rate of tax, which is 25%. But before you do that, you look at your income from the business. So from your income, you take out any expenses which is allowed under the Act as a deduction. So that you deduct all these deductions and you have what is called your profit. So for businesses, we tax your profits, your profit. But there are rules to what we do. And if you prepare your accounts such that it violates the rules for taxation, then we will disallow them and do what is required by the law. So we began looking at some rules on business deductions. And we said that there is a general rule that anything of capital nature should not be granted as a deduction. When we say something is of capital nature, then it means that the benefits we are going to get from that expenditure or deduction goes beyond 1 year. And because of that, you cannot deduct anything of capital nature. And then there are specific rules, such as interest. And for interest, I say that though interest is allowable deduction, it comes with some attached strings. For instance, where you are exceeding your capital structure, the debt to your equity. So whenever you have anything on interest, before you say is going to be deducted, compare the debt to the equity. If your debt is in excess of your equity by 3:1, then we are saying that it should not, all the interest should not be deducted. In the same way, where there is a finance cost, we said it comes with a limitation. You see finance cost, don't quickly rush and go and say all the finance cost is allowed. If you have a finance cost, the law is saying that there is a limit to the amount of finance cost to be deducted. How do you do that? Take all your income, then do your allowable, non-allowable, do those adjustments. When you have adjusted this chargeable income or profit, then what you get, the adjusted profit or adjusted chargeable income. What do I mean by adjusted chargeable income? We are saying that the law doesn't allow every deduction. to be done from your income. So what you do is that where somebody has done something which is against the law, disallow them. Do those things. If there is depreciation per the account, the person prepared and then added, subtracted depreciation. So to arrive at net profit. So this net profit is per the account that was prepared. If I say adjusted chargeable income, it is not this net profit in the account, but what I call adjusted chargeable income is the net profit per the tax rule. Per the tax rule, depreciation is not allowed. So I take this net profit per the account, then I add back the depreciation. When I add back this depreciation, I have changed or adjusted the net profit per the account. So all the allowables and non-allowables, you do all of them before you get your adjusted chargeable income. Are you following what I'm saying? After getting this chargeable income, the access financial cost limit. Then take 50% of the adjusted. So 50% of adjusted chargeable income. Then add the finance gain. So from this one, you now charge the finance cost. So this one is the limit. The limit. So assuming my 50%, my adjusted income here was 1,000. When I come here, I'll find 50% of that 1,000, and that will be 500. Then maybe the gain on the financial instrument was 100 C, so I get 600. What it means is that the finance cost that is allowed to be deducted from your income should not be more than 600. You only grant finance cost up to 600. Anything in excess of the 600 which was deducted will be disallowed. And the amount that you disallow will be carried forward for the next 5 years or 7 years. But now that we are looking at carry over also 5 years, I think we should also look at it and bring it to 5, because it's also a profit from business. So there is a limit on finance cost, the amount of finance cost you should deduct. And I only touch on those ones because candidates will see finance cost and they'll say it's good to be deducted because it's a cost. No, finance cost for companies which are not in specialized entities or industries have a limit to their finance cost that can be deducted. It says before you can deduct any finance cost, the limitation is that it should be your finance gain plus 50% of your adjusted chargeable income. And I'm saying that how do you get the adjusted chargeable income? You pick the net profit per the account and do all necessary adjustments according to the tax principles. If there is allowable deduction, the person has deducted before getting this net profit, fine. But if there are some deductions which are not to be allowed and the person has done them, disallow them. You disallow if it's a deduction, then you add it back. If it should be allowed, then you deduct. Are you getting it? Then, in talking about this adjusted chargeable income, this finance gain is part of what the person has done. The finance cost has also been deducted. So when you are adjusting, the finance gain was added. So what do? You subtract. The finance cost was subtracted. What do? You add back and do the other adjustments to arrive at your chargeable income, which was adjusted. So you should exclude the chargeable income we are referring to, should exclude the gains and then the cost. Today we will not close at 4. We close earlier than even break time.
Break is 12.
Huh?
Break is 12.
Break is 12. Yes. Because today we have a wedding to attend.
Yesterday was
Yesterday was funeral.
wow. Yes, it's allowed.
It's allowed. So I wanted to inform you that we are not meeting, and I also thought that we stay away for 2 weeks. If we don't meet, you say we have ended the lessons. So I have 2 questions posted this morning. And when I'm away, you will not leave. We will discuss. I'll give you a question for discussion until 4.
It's like some of us also have waiting for.
Then we are ending at 3:30. I posted 2 questions there. One Mama V and then the other ST. The Mama V is very simple. For business taxation, all that you need to know is which deductions are allowed, which deductions are not. Immediately you glance through the question, read the requirement, then anything that has a note attached, you consider it first. If it doesn't have a note attached, then it means maybe it is allowable. So you forget about it. Apart from depreciation for that one, there wouldn't be any note to tell you that it should be disallowed. Anything that has a note attached, go and read it quickly. Because in reading, it will indicate that some components of that deduction are not allowable. So if they are not allowable and they were deducted, adjust it by adding back. So how do we adjust an account? Like I have said, first pick the net profit per the account. So how do you adjust the financial statement given you? And always is the income statement, profit and loss. Let me put it that way. Adjusting the income statement. So you pick the net profit per the account. So the account giving you what is the net profit? We will use Mama V. I work, you will choose between Mama V and ST. You will go through. When I finish this one, you choose between. So take the net profit per the account giving you. Then any add back. Add back. What do you add back? All non-allowable what? Deductions. Add back all non-allowable deductions made in the account. So what are some of these non-allowable deductions? What are some of them? Depreciation. You will put it down. Depreciation. Example, depreciation. And amortization. Non-allowable deductions.
Deductions of capital nature.
Okay. Deductions of capital nature. Deductions of capital nature. Example of a deduction which is of capital nature. Like you take money to acquire a fixed asset. You make a repairs which is going beyond the 5% written down value of the asset. Or you make maintenance, which is improving maybe the useful life of the asset. It is capital nature because the benefit is going to be enjoyed over a period of maybe 5 years or 10 years or whatever. So it may be this one. If you have a wooden one, no, okay, this is what you have. And then we intend to change this one to maybe what is of higher quality than the river blade. What? Grade this one. So if the river blades, we intend to change them to a graded one, which will enhance the useful life, then definitely it is not what repairs. So the person will deduct it as repairs. And you, with your understanding that the river blade, this time when it is changed, this we have changed them. So it is changed entirely. Because of that, the benefit will go beyond 1 year. But let's say we come, this one is not there. And then we decide to fix only this one. And it costs us 500 Ghana. That one will be seen as what? repairs, and it's allowed. But if we decide to remove the entire louver blades and change them to maybe air conditioning room and others, then that is not what repairs. We take note of that. So add back any non-allowable charges. Yes.
That explanation means any upgrade it shouldn't be considered a deduction, but making it just normal standard is allowed.
No. We don't have any standard set. As in this is what we are using today. If we decide to change this one, there is a change of it. Entirely to something different.
That's an upgrade of it.
I will not say upgrade. I don't know what you mean by an upgrade. Because somebody can have this one and then can change this one to maybe a wooden one. If I change this one to a wood, if I change it to wood, even though the quality of it, per my standard, is not the same as the louver blade, still, because I have changed this one entirely to a different thing, the benefit is not what a repair.
Although it may not enhance its useful life, maybe that one will even reduce the useful life. But
because I have changed it entirely, then I cannot consider it as repairs. And remember, there is a rule on repairs that the repairs you do should not be more than 5% of the written down value of the asset at the end of the basis period. So if this is what we are going to change, any maintenance we make should not be more than 5% of the value or written down value. When you say written down value, we mean cost less after allowance for tax purpose. So capital allowance, maybe because I will see it, we thought it's cumulative. Capital allowance. That will be your written down value. But if there is any addition to the cost, you can do that. So the written down value, please, this is at the end of the basis period. So if this written down value is the beginning of, it is the end of 2022, the end of 2022, I had this written down value. Then I decide to repair this asset in 2023, then we are saying that the cost of repairs should not be more than 5% of the written down value of this asset at the end of 2023. Written down value, this is for 2022. So if I decide to maintain this asset, repair it in 2023, then the written down value in 2023, if I work 5% of it, then it is the amount of repairs that is allowed to be deducted from your income. The excess repairs which could not be deducted because of the rule is added to your cost of the asset or written down value and capital allowance chart in the year. So please take note of these things. Now, same with the number I want to turn October. Then you add back these things and then you less any deduction allowed, but which have not been deducted. And what can we talk about here? A deduction under the law which has not been deducted before they arrive at this net profit. There should have been some deductions. One major one you can refer to is what? Capital allowance. Capital allowance. Example. Please, capital allowance. I think last 2 weeks we did that. How many classes of assets do we have to grant capital allowance on? How many pools? Which assets runs a pool? Which assets run no pool? The methods. Because each day the examiner gives you the amount of capital allowance agreed with the commissioner. Who knows the day that maybe this sitting, they will give you a list of assets and you have to determine capital allowance on your own. And that is ST in December 2022. That was a surprise for me. Because always they were giving the amount of capital allowance agreed with the commission. And this time they went there, they were told these were the classes. With some strings attached. It is not going to be simple, but with the knowledge you have had, you need to sail through and pick up your 51, 55, 58. So how do we compute capital allowance? Know the various classes. Class 1, 2, 3. They run a pooling system. In that pool, after the year of acquisition, in that pool, any asset loses its identity. So you can buy and the value is 50 cedi, you have to include it. Don't say it was bought in 2003. There were assets there in 2002. So you go and keep the 2003 in its own pool. If they are of the same nature, then you pull them together. They run a reducing balance system. So if today you charge a class 1, what assets comes into class 1? Computer and accessories and other data handling equipment. What is the rate? 40% on reducing balance per annum. So you have to know this. taxation of business income. It comes with its own rules. Apply them. Then, apart from knowing capital allowance, the classes, which assets come into the various categories. Classes 4 and 5, they maintain their identity, so don't pull them together. If you buy a class 4 asset, then it must be put in its own class. So class 4, you can have 4A, depending on the year you bought it. You can have 4B, depending on the year it was bought. But for classes 1, 2, and 3, the year in which the assets were acquired doesn't matter. Pull them together and grant 20, 40, and then 30% capital allowances. Any question? Because I have one, ST, that's why I gave 2 examples. Then, because I'm not end with you, you go and take July 2003. July. This 2003.
Last 16 or
July 2003. Who's running? Yeah, well, 2023, September. And I'm in July 2003. I said July 2003. So you have so many examples to practice. The only issue is that we don't practice because the same principles are tested. Here, where there is a finance cost listing, I want to add something. Where there is finance cost in corporate income taxation. Remember, we said we have to adjust to determine the chargeable income on which we will work 50%. In that income, we excluded finance cost and then finance gain. So when you have done this, add back, add whatever, the finance cost, which you deducted finance cost, you will have to add back the finance gain. Then you come and deduct the finance cost limit here. Please take note. It is the limit. So if the limit is the same as what the person deducted, then fine. But if it's not the same, then the one which is allowed under the Act will be the finance cost that will be deducted. I'm saying it again. Somebody has made a net, okay, let me say, profit before gross profit 6,000. Then less finance cost. $700. Depreciation 800. So these are the only 2 I have. And I'll have net profit of how much? What? 4,500. So I give you additional information. included in the gross profit is a finance gain of maybe 300. Then I ask you to recap, compute the tax payout. This is a very simple question. So we go through this system, adjust whatever happens. So gross profit is 6,000. Included in that is a finance gain of 300. So what it means is that this net profit has an element of 300 in it. It also has a finance cost 700 deducted. So what I do is that I have to determine the financial cost limit to see whether the person should deduct all this 700. Are you getting it? So what I do is that I take the net profit per the account, and it is 4,500. Included in it is a finance gain, so I must less finance gain of how much? 300. Then what do I get? 4,200. Then are there some adjustments? Included is also finance cost. So I add finance cost 700. There was depreciation, so it must be added back. So add back depreciation of how much? 800. Then you add the 3, and what do you get? 5,700. So the question says that your finance cost limit, that is how much finance cost can be deducted. It says it should be 50% of your adjusted chargeable income. Adjusted chargeable income, and that is 5,700 times 50%. All 50% of that. 2,750. 2,850. Then you add finance cost of how much? The 300. And that is the finance cost.
Finance gain.
The finance gain. I think this is 300 once again. Okay. The finance gain. And how much will it be? 3. So it means that the person can deduct finance cost up to 3,150. But how much was deducted? 700. So all the 700 is allowable. Is allowable. So you don't have to do anything. So what you say is that since the finance cost deducted is within the limit, then it is allowed. Since the finance cost deducted is within the finance cost limit, then the 0700 is allowed. So what happens is that we had 5700. This was what brought my example, that you have done these adjustments to this level. Don't forget that you have adjusted the gain and then the cost. So when I get this 5700, it means that this 5700 doesn't include the gain and the cost. So what you do is that you have to add finance gain of 300 and then less finance cost of 700. And what do you get?
5,300.
5,300. Oh wow.
5,300.
5,300. You say I've been doing wrong. So this becomes the chargeable income after adjusting for depreciation. Just to confirm that 700 we are what and one Sankawaya we are what 7,000 and now the limit near 3,150. So you can only come here. Finance costs are over to the higher 3,150. Not the Rebecca out of 700. This is allowed. Then the non-allowed will be 3,850. So this not allowed. Someone did you This not allowed. The person would have deducted 7,000. So you will come to this level and then will deduct 3,150. Then you will say that the 3,850 will be carried forward for the next 7 years to be deducted against future finance gain. That's it. So please, when there is finance cost, things are on test here. So if there is capital allowance, then it will be deducted. After the capital allowance, then you tax it at this one. I did not give any capital allowance, so tax payable will be at 25% of the amount. So please take note. We choose between ST, E, and then what is it? Mama V. One thing I did not mention is that, and I have always mentioned it, so I think when I say it now, you will recall that at times, as part of the person's income, the person's revenue, you will see revenue which are or which have suffered a final withholding tax. Final withholding tax. Any revenue which suffers a final withholding tax should not form part of your revenue and tax. So if you see that we are adjusting financial statements, go and then deduct them. Are we okay? We are saying that investment income, when we are taxing business income, we tax your profits and your gains. So let's say the person makes an investment and the person gets income from that investment. We are saying that exclude that income from investment and tax the business income. You determine the business income on itself and then tax it. Or when you have done that, you then come and add the investment income. But I'm also saying that if they don't put it that way, what you will see is that as part of the person's income, you will have some income which have suffered final withholding tax. Anything which suffers a final withholding tax shall not be included as part of your income. Exclude it. If that is what the person has done, exclude it. When you have excluded it, you can choose to later add the investment if it has not been taxed. But any revenue or profit which is on withholding on account, for that one it must be added, and then you add it at gross. And then the tax that was withheld, you come and grant it as a tax credit. So let's take STI and then so read through the two and select one for us to practice. I select ST. Let's take ST. So Somebody should read ST. Master, IT man, are you following the advanced tax platform?
Listen.
And you are the IT man this morning. We are asking you questions on that. As you have said, the training set on this class was March. Who join me online? Me, this year. Who to me with some question on my answer. I say, one answer for you. Okay. ST. Nobody should read that one. Read the requirement.
Okay, so requirement for the
ST.
calculate the maximum capital allowance.
It's okay. Calculate the maximum capital allowance. So, what comes to mind? You are going to compute capital allowance. It is not given to you. You will compute the capital allowance. Then the next one,
Calculate the chargeable income
the chargeable income
and the tax payable by ST.
and the tax payable by ST. So what it means is that you are not only going to do capital allowance and say that is the end. When you finish, as part of the bill, that capital allowance you computed will be deducted as an allowable deduction. So,
Which year, please? It's not because I'm not seeing it.
you've not seen it. Oh, if you have it, it is December 2023. December 2022. December 2022. So one more confusion. So I want us to get the implication here. What it means is that if we get our capital allowance in error, I will not say wrong. If we get it in error, it means that it is going to have influence on the bill. Are we okay? So what goes into capital allowance computation? It is about depreciable assets. So we go through the question. It says compute the STE. Is it ST Incorporated Limited? Head office. Is it limited?
Limited, yes, sir.
When I'm home now. Okay. What are you doing?
The third requirement is capital allowance.
So computation, you have to carve your own head note. Computation of capital allowance for
For the year ended 3rd December 2021.
for 2021 year of assessment. Then the basis period. (2021). When does the accounts get prepared?
First.
31st December. So it means they start from 1st 2021 to 31st December 2021. Were we given depreciable assets? Do you have any information on depreciable assets? There is not every asset. We are only interested in depreciable assets from 1st 2021 to 31st or anything earlier. They are fixed assets registered, so maybe they have been in operation. They have been operating for some time. Okay. What is contained in their register? Were we given the cost and their respective depreciation? So let's get the table right. Computation of capital allowance. So we will have classes or pools, or maybe class 1, class 2, or pool 1, pool 2, class 3. Don't know if there's class 4. If there's class 4, are they separate or what? I don't know. Well, let me leave enough interval. Then class 5. What is the currency? Please don't forget them. Ghana cedi. Ghana cedi. I call these ones cheap marks. Then we said we are giving cost. Then did they buy some later in the year? Addition. Then did they dispose some? So disposal. I am imagining them, or I don't have the information. Then cost, addition, disposal is deducted. Then we grant capital allowance. Then we deduct the capital allowance to have written down value, carried down, then it will be brought down. I don't know, or brought forward. I don't know the information. So when we have finished computing, we get our total capital allowance. How were the assets given? Which assets? Do we have class 1 assets?
Yes, sir.
What are they?
Office computers.
Class 1, office computers. How much? 80,000. Is it the cost? So you come here, class 1, cost 80,000. What again? Is it the only class 1?
Yes.
were there additions after the year or during the year? Were you given that class 1, 80,000, class 2, this? So you have to put them and know them. Oh, that's very nice. That's why you are finding it difficult to tell me. Let's go to class 2. What assets come under class 2? No, don't look at your question now. Which assets come under class 2? So, do you have some of these things there? No class 2. No class 2. No class 2. What are the assets? Mention them.
Head office building, factory building,
Head office building, and then factory building.
furniture and fittings, and office computers.
Oh, okay.
That was the ones in the register, but when they applied the loan, they got
Plant and
some
machinery.
others
No, we want to finish the cost.
in the register.
So the buildings are how many?
2,
And what is the cost?
270.
You put the two together because they are acquired in the same year. 270. And what class is it? Class building. No. I said that if they are acquired in the same year, if they are acquired in the same year, you also look at it. If they are acquired in the same year and they have the same useful life, then you can put them together. Or all of them will be taxed at 10%. So if their useful years are the same, then for the first time of acquisition, put them together. Any subsequent listing, maintain a separate what class or pool for it. 270 places class 4 buildings. And the rate is, this one the rate is, let me put the rate somewhere. Rate 10. Continue. And then the other class, office come under which class?
Class 3.
Class 3. How much?
65,000.
So the cost of the acquisition. Are there additions?
Yes, sir.
Let's read through. Which line do you have the addition?
The intro. Shall we?
Yes.
STC was incorporated in 2020 and commenced its operations.
So it was incorporated in 2020 and started operation.
Started operation
First January 2021.
2021. Okay.
specializing in the manufacturing and distribution of solar panels, solar lights, and solar power related products. STC head office and business premises were situated in Tema.
So they are in Tema. Head office and
Business premises.
were situated in Tema.
On 30th of June 2020,
So if I am the examiner and they wanted to give you a free mark, they will say what is the tax implication of having the headquarters situated in Tema. No tax rebate. Then they will give you 1 mark. Why? Because all manufacturing companies situated in Accra or Tema pay tax at the rate of 25. No rebate, no reduction.
On 30th of June 2020, STC successfully applied for a 2-year loan.
He applied for a loan, so loan finance applied for a loan of
750,000 Ghana cedi
750 Ghana cedi.
with an interest of 15% per annum.
Interest, so this is the principal amount taken, and then interest of 15,000.
Percent.
15%. So let's work 15% of 750.
11250.
11250. Yes, amount.
That's a man zero.
And they are going to pay this loan in how many years?
In 2 years.
So the interest payable per year will be this one spread into 2, because you cannot charge all the interest in 1 year when we are going to benefit from 2 years. Are you getting it?
50 per annum.
Per year.
So this one is per year.
50 per annum. Okay. So this is per annum. So each year. So each year they will be paying 112,500. Okay. Continue.
So a really local financial.
So 20. They took the loan in 20 what?
30th June
10 years.
2020.
So by December, please let's get the principles right. They prepared accounts to 31st December. So by 31st December 2020, which is how many months?
6 months.
They will pay half of this one. So 112,500 spread into 2. Interest payable
56250.
20.
56250.
Then we will come to first one, 2021 to 31st December 2021. And we will pay how much?
11250.
112,500. So in 2022, they will still have something to pay, which will be
56250.
1/1/2022 2. They will pay 56250. So that in total they are paying how much? 22,5. So please, we are preparing accounts to 2021. So 2021, if anything, we have to pay this, to charge this. Maybe there will be some other information, but this is a loan that was taken. And because they took this loan in 2020, when they had not started operation, then what is happening is that it could happen that they use the loan to acquire assets. So if the loan was used to acquire assets, then we have to include them as part of the cost of the assets and capitalize them and compute capital allowances. Are you getting it? Because this is not interest you are paying on the products, the goods. Otherwise, it would have come right away through your P&L interest and you deduct. If that is the case, then you would have deducted only 112. But these things, this one, 2020, the assets, we have not generated any income for which we should match against our revenue. So you cannot charge this one when you are not making any income. Because look at when they started operation. And this is also a good ground for examiner to test you.
So we apply the knowledge for the CR, that's IS 23.
IAS 23, borrowing cost.
Do you apply it?
Somehow, because when do you have to capitalize?
When the borrowing costs are being incurred, when the expenditure necessary for the borrowing costs is all the
Say beyond. But when there is a cessation, remember this one, they did not use it for construction. I don't know what they use it for. He said they use it and apply for one. I don't know what it was happening.
showroom construction.
They did a showroom construction.
Procurement of plant machine. Procurement of raw material.
So let's consider what they use this interest to acquire. Is it the loan?
Sure.
So the loan amount is this. The interest they have to pay per annum. So this loan was applied on showroom of how much?
100,000. Plant machine 250,000. Raw material 300,000.
Raw material
100,000.
300.
Yes. Commercial vehicles 70,000.
Commercial
Vehicles, Joshua
70,000.
Then the total is 720,000. That's total amount applied during the year ended 31st December 2020.
This is 2020.
Yes.
How much is it?
The total is 720.
3.
720. 720.
So what will be left is
30,000. Which is
30,000.
amount applied towards 2021 consulting fee. Consultancy.
Yes. So the 2020 interest, the 2020 interest, you have to add them to this cost. The 2020 interest will be added to the showroom and others, provided that they don't include the interest. So how do you do that? How will you include the interest? How will you include the interest? Showroom, plant and machinery, raw materials, 300, and others. How will you include them? You only make apportionment by taking maybe 100 on 720 multiplied by 56 250. Then you add it to the 100. Please do their voice limit. And you were to do this in maybe 36 minutes. So if you have not practiced before, you will smart class 1, class 2, and then you will say stop it. Please, can you read ahead for me?
Okay, so ST, okay, the fixed asset procured using the loan were not included in the fixed asset register, and neither was the expenditure on raw material procurement recorded in STC. These assets were first brought into use on 1st January 2021.
1st January 2021. So these ones, these assets that were acquired from the loan were not recorded as part of this, the operation. So what it means is that there were additions. Okay. In 2021. Continue.
STC statement of comprehensive income for the year ended 3rd December 2021 is as follows. 10. Cost of sales, excluding the initial raw material, gross profit.
Excluding the initial raw material, because then we have not started operation, so you cannot charge that cost. So that will go into your working capital. Maintain it in working capital. Okay, continue.
Gross profit. Other operating income, bank interest, sales commission, VAT refund, less operating expenses, staff welfare, repairs and maintenance, insurance, depreciation, advertising and marketing, renting and stationery, utility cost, motor vehicle expenses, industrial research and development,
Okay.
operating assets, interest, general expense, net profit before tax, corporate tax paid, net profit after tax, notes. 1. Staff welfare. Salary.
Okay, let's discuss them. Staff welfare. Staff welfare. How was it usually?
Salaries and wages.
So when you pay your staff wages, is it allowable or not allowable? It's allowed. If you pay wages of your staff, Where do you want to go and deduct it from? So why did you say it's not allowed? So the salaries paid to the workers allow what goes into it again?
Consultancy fee.
Consultancy fee of how much?
30,000.
30,000.
30,000 for the loan.
Has it been notified that it is the 30,000 here?
And the amount.
No, you don't need to generalize like that. But it says
For the fact, additional.
2021.
Yeah,
Let's
yes,
talk about, there is an
additional-
information to it, the consultancy fee.
It was funded from their loan balance.
Okay, let me jump to that section. The consultancy fee was paid to the
Well, do you see the wages and salaries? The wages and salaries.
Yes.
Staff welfare, that is.
The staff welfare.
Under that,
Under that you have
Consultancy.
consultancy fee.
wages and salaries, staff training, SSF and pension contribution.
Then you
There's a note below
One
it.
out for wage payment.
I want to get something.
There's a note.
This consultancy fee 30,000.
The-
And where are you
small
reading the
loan.
note?
It's under.
Under
The consultancy fee was paid to a U.S. company, which seconded an expatriate who was engaged from this to this on the basis of temporal work permit. The expatriate was also tagged with the test running. The consultancy fee was funded from the loan balance. Okay. So the loan they were paying for 2 years. 2 years, 30,000.
Consultancy fee.
Well, they are paying this loan for 2 years. For 2 years. So this fee here, 70,000. It means that we are not going to get the benefit in only 1 year, isn't it? So we have to get the benefit over 2 years. True or false? So we have to spread this one into 2, the 30,000.
I am within 2021.
They paid it in 2021, but the loan period, the period that we are going to pay for the loan, that consultancy fee was part of the loan. It was part of the loan. That's why I'm thinking of spreading it over the loan period. So that we have 15,000.
But they stated that the amount was applied towards 2021 consultancy fee. So doesn't it limit the amount to
Oh,
2021?
okay.
It was applied towards 2021 consultancy fee. Fine. So that consultancy fee will be paid in 2021. But the loan was taken in 2020. The person also was engaged for how many years?
It's not much.
4 months.
4 months.
No, 5.
It's not up to
5 months.
5 months.
So that is why I want to spread, because they will be paying interest on this amount. They will be paying interest. Interest on that amount. So we have to allocate that one to continue.
This one. Advertising.
So for wages and salaries of your staff, is it allowable or non-allowable? Allowable.
Consultancy fee. Staff training.
Staff training, you train your staff. Is it allowable or non-allowable? Okay.
Net pension contribution.
PAYE. Allowable or
No,
not?
this is net.
Okay.
Net and pension contribution.
Are they allowable? Okay.
Penalty for late pay. PAYE.
Penalty for
Late PAYE.
late PAYE. You deducted, the time was due for you to pay.
Pay and they didn't pay.
Is it allowable or non-allowable? Non-allowable. Because we said that domestic and excluded expenditure. And we gave excluded expenditure as fines, bribes, and others. And this one, anything on breaches of the law is okay. So you did not pay and you have deducted. Do we allow you to deduct?
No.
So you begin to add back. Are you getting it? Continue.
Staff end of year party.
Staff end of year party. After the year had ended, you give gifts to your staff. If we have to include them as part of their wages, then under that situation, they are going to suffer the tax because it forms part of their allowances. So they will pay the tax. If that is the case, then we can deduct it, grant it as allowable. But if that is not the case, then it should be disallowed. Please take note here. Staff listing. If the company pays maybe staff allowances during the end of the year and it forms part of their pay, then you, the employee, is going to pay PAYE on it. But if the employer decides that it will not form part of their staff emolument, so during the end of the year, you dash out monies to them and then you come and deduct it from your account. Do we allow it or not? It will be disallowed. Are you getting it? Please take note of when it comes to that canteen service, welfare, this thing. If everybody is benefiting, fine. If it is taxed in the hands of the employee, then it's allowed. But if it's not taxed in the hands of the employee, then it must be disallowed. Continue.
Advertising and marketing. Advertising and promotion of solar products in foreign markets. Local market research. Advertising and trade fairs. Space rental at the Ghana Trade Fair exhibition.
Allowable or non-allowable? This is what I want you to do. I will not do the computation. So we say this one is non-allowable. So the non-allowables are what I need. So that you go to your account and what you'll be doing there is add back all the non-allowables. You go and add them back.
Solar magazine launch.
Launching of your product. Do you allow it or disallow? You create awareness of your product.
Marketing director, family and friends entertainment.
Entertainment of marketing and director. Is it allowable? It's a personal or domestic expenditure, so you have to disallow.
Utility cost.
Utility cost.
The 15 water charge allowed. water supply allow the installation of the solar.
Water supply to they did not state.
Let's say water supply.
Yes, water supply.
Where was it supplied to? Maybe it was supplied to the CEO's office
Or maybe
or family. Okay, it's okay. Nothing was said about it. Continue.
So allow, yes. Okay, next one. Installation of the solar panels for the thermal showroom. Allow.
How much is it?
36 watts.
The Tema showroom.
Yes.
There is the showroom here. And it was under construction. 2 of us. How much was it? So do you go and add the utility for constructing that showroom as a cosmetic expenditure, or you treat it as capital expenditure? That is the minimum. Anything of capital nature is disallowed. So you are constructing the showroom and then you put in solar panels or what?
Solar.
So what happens to it?
I mean, it's more than 5%.
And then can 5%. This is not repairs and bringing 5%. This one, the person is constructing the showroom. And the person says, the showroom is constructed for 100,000. We build the showroom. We have to install solar panels in it, like we have lower blades. This time it is construction, and it forms part of the showroom. It can be considered as construction of the showroom, the cost of it. So you add it to the cost and then capitalize. Are you okay?
But you think because it's a different item altogether?
No. Solar panels. Solar panels are capital nature.
So,
They are depreciable assets. But read that portion.
Utility cost. Installation of the solar panels for the thermal showroom.
And it was done at the showroom. It's capital nature. Capital nature. So you have to include it as part of the cost of the showroom. So you disallow it here and go and add it there. Continue.
Motor vehicle
So
expenses.
I'm not getting you that. You just align one, I'm not getting you.
it's a capital asset, so it's not an expense. So it will not be part of the expense of electricity. It has to be added to the cost of the showroom.
After the what I said. Continue.
Okay, motor vehicle expenses. Fuel and vehicle services, 33,000. Insurance and allowances, 5600. Vehicle tracking equipment, 30,000.
Vehicle
Tracking
tracking
equipment.
equipment.
30,000.
Is it a deduction?
And you have to add it and capitalize it, then you go and grant it.
So you disallow it here and then you capitalize. Please, are you following the discussion?
Yeah.
Because and yet, say we fit here and now when you addition. You disallow something which was deducted and come and grant it. Hey, mechanics also want the amount disallow in amount capitalizing. Anything of capital nature shall be disallowed. And if it's a depreciable asset, it should be included in its respective class. and granted capital allowance. So that 13 whatever, it says it was installed in the showroom. So you have to include it in the showroom,
Add it to the amount of the showroom.
the cost.
It was 100,000 for the utility.
Yo. Let's continue.
5. The total amount was contributed to Energy Commission of Ghana towards the research on solar power cookers, heaters, and refrigerators. ST intends to broaden its product range by including these solar items in the near future.
Are you reading general expenses or what?
Additional information on there.
Yeah.
Additional information.
Yes, 5. Yeah. It says the total amount was contributed to
Total amount from where?
This is total amount.
No,
The motor vehicle expenses.
they would have said something before.
We have under the news, we have 1, 2, 3, 4, and I'm now at grade 5. Grade 5 says the total amount was contributed to Energy Commission of Ghana towards the research.
No, the 5. Is it linked to a note?
Yes, it's linked to the financial statements. It's industrial research and development. It's 33,000.
Yeah.
So do you allow it or not?
The industrial research and development is linked.
Okay, note 5. Okay.
Check the notes in that way.
Yes.
So that you will determine whether it should be allowed or disallowed.
The total amount was contributed to Energy Commission of Ghana towards the research on solar powered cookers, heaters, and refrigerators. STC intends to broaden its product range by including these solar panels in the near future.
So this comes to section on research. Section on research. Then I said that research, what is the definition of research? The cost you are incurring on anything that will influence or enhance the product or your service. And here STE is into production of solar panels. And says he paid something to Energy Commission on the solar panel. So it is towards advancing what? The products. So it qualifies as research what? Expenditure. If it's research expenditure, then it says that for businesses other than, I am modifying it that way, other than mining and then petroleum, it is allowable deduction. Research. But if it's mining or petroleum, it is non-allowable. Please take note too. Okay, if it's research, remember we said research is about helping you to improve your products and then services. So any activity you undertake to improve the quality of your product or to help you produce better or find new products, then that constitutes research. The act says that if you are into business and you incur any research and expenditure cost, whether it is of capital nature or not, it should be allowed as a deduction. Unless maybe you are operating in mining or petroleum, the special industries or sectors. For them, if you have research and then development, we don't allow them as deduction. There is a treatment. When we reach, we will cross. So is this research, it should be allowed. Continue.
Okay. Note 6, operating license. The total amount was paid to the TMA as the initial operating license for the factory.
Initial
License cost. And that amount was paid to the Tema Metropolitan Assembly as the initial operating license for the factory.
So is it allowable or non-allowable?
Allowable.
Huh?
Allowable. Anytime
It's an asset in class.
Five.
So what is the useful life linked to it? They did not. How much is it? And it was paid to
the Tema Metro CMA.
on what?
Initial
Operation.
Initial operating license. Then it can be allowed. Can be allowed. Because if without the license you cannot what? Operate.
Seven, interest. 2% loan establishment fee.
2%.
Loan establishment fee of 15,000.
Okay. 2% loan establishment fee.
2020 interest paid. 56, 250.
So are they giving the breakdown or what?
Yes, they are just giving it.
2% loan establishment fee.
Of 15,000.
15,000. Okay. Then
2020 interest paid.
2020 interest. By that one we did it.
5, 6, 250. Yeah.
Excluding this one.
Sure. And 2021 interest paid 1125.
2021.
1125.
I think that was what you did. Then 2022.
No.
Nyanka Mulaba. Now they back confused. What the back can So what it means is that we will have to capitalize with 15,000 and we capitalize. Because why are you doing that?
The interest rate in 2022, will it be part of the 2021?
This is 2022, 2021.
2020, won't we leave it? Will we add it to the?
I said that 2021, the interest paid in 2020, at that time we had not established began commercial operation. So that loan that you took, what you do is that interest portion, the loan was taken to acquire assets. So the interest portion should be capitalized as part of the cost of the asset and granted capital allowance. Because for capital allowance, they are not carried over. What will happen is that if we charge capital allowance and then it is bigger than our chargeable income, the only thing that happens is that we make a loss. That tax loss is carried forward for 5 years or 3 years. So you cannot say you are not going to treat this one. It will be treated. But how are we treating it? 15,000 is the establishment fee. Then the interest portion is 5, 6, 250. You put the two together and apportion them here. Because the loan, it was on the loan. And they took the loan 750,000 and they used it to acquire this. And look at how the general expense was treated. It says it was deducted in 2021. So that one is okay. It was deducted in 2021. But these two,
first two are not allowed as expense.
They will not be allowed as
Expense in 2021.
expense in 2021, but you add them to your assets and grant capital allowance on them. I think we have finished. Yeah, can
No, number 8.
General expense. Legal fee for the dietary fair show lease agreement. Allow.
So that's right.
Architect fee for the parking building plan.
Architect fee for the building plan, allowed or non-allowed?
You add it to the cost of the building and capitalize and grant capital allowance.
Perfect. And then you disallow here. You disallow here. Staff tea.
Staff.
Moye ni nyina, mi de mi na
It
mi
was
na.
in the ready to every morning.
No, but because EC 69, one of the party rep says so for humanity. It's a went to me, it is it's happening. Oh,
Staff tea.
and refreshment.
Is there something added to it?
Staff tea and
Anyway, refreshment, that's all.
Staff tea and refreshment. Bread.
No, maybe it's staff.
For the staff. So everybody.
Why didn't they treat it under staff welfare?
Because everybody enjoys it.
Okay, so allow it.
Office cleaning.
Office cleaning, is it allowed?
Allowed.
So if the staff tea is available to all the workers, then it must be allowed.
If it's for a selected field, that one is not. Donation to the government.
Donation
Political
to
part is not the government.
donation to.
A political party.
Please let me talk on section 100, donation to the worldwide cause. Please, it is allowable. Donation to a worldwide cause is allowable, but on condition that one, what are some of these, the nature of donation towards a worldwide cause? It should be towards A, B, C, D, promotion of sports. So if it's towards sports advancement, then to benefit from that donation, then you need the minister's approval.
But are you donating to the sitting government or?
Please, we've not mentioned government.
They say political party.
No, I'm not talking about political party. I'm talking about donation towards a worldwide cause. When I finish, I'll link it to this one. Then, section 100. If it's towards promotion of community or rural development, then you need the approval of which minister?
Minister of local government.
Local government. Then the next one is towards advancement of education. Can somebody read the section 100 for me? Or they are about 4 or 5. Education, you will need whose approval? Minister of Education.
Then health food. fact.
Yeah. I want you to read it. Section 100.
That's also actually.
Where the income for a year of assessment in respect of a person who has made a donation
So a person who makes a donation,
or contributed
or you contribute to
a worthwhile cause
a worthwhile cause,
is to be ascertained under section 2. The person may claim a deduction that is equal to the contribution.
so you can claim a deduction to the amount of the donation that you made towards the worthwhile cause.
A donation made by that person during that year for a worthwhile cause approved by government under subsection 2. The following causes are worthwhile causes approved by government. A charitable organization.
A charitable organization. So you go and make a donation to a charity home.
Which meets the requirements of section 97.
So when you go to section 97, it tells us what a charitable organization is. Any organization which is not for profit, making the intention, which doesn't use its platform for the advancement of or any political party. Continue. So a charitable organization, you can add that one. The nature should be.
It's 76.
So can you go to the 97? So that we know the character of a charitable organization.
97. Approval of charitable organization.
When will the commissioner approve a charitable organization?
The Commissioner General may approve an entity as a charitable organization for the purposes of this act. The Commissioner General shall, before approving an entity under subsection 1, ensure that A, the entity is established to operate as a charitable organization.
The entity is established to operate as a charitable institution.
Which is of a public nature.
It must be of public nature. It must be a charitable institution of public nature.
A religious institution which is of a public nature.
A religious institution of public nature.
A body of persons formed for the purpose of promoting social activities.
So we want to promote our own social activities. Any group of persons or body of persons will form or be considered as charitable organization.
Or sporting activities.
Promoting sports.
Or a registered sporting.
So you register to be a club. So what it means is that all these considered in section 97 as charitable organizations, all their income are exempt from tax. So if you make a donation to them in section 100, we are saying it is towards a worthwhile cause. But that, have you finished reading that one? That party or charitable organization you are donating to should not use their platforms to engage in political activities. Support a political party. So if I go and I'm a business entity and I go and support Ken because he is my favorite and I come and charge it to my, what is it? As allowable expenditure. But when I go to the orphanage,
National Cathedral.
National Cathedral. Is it of religious nature?
Yes.
Is it of public nature? Huh? Cathedral, is it of public nature?
Yes. Public interest.
Who will give you the approval? So when it comes to the charitable organizations, then the approval should come from the Commissioner General. The approval should come from the Commissioner General. Any other worldwide cause approved by the Commissioner General can be added. So if you go that you have donated to Cathedral and Commissioner says that, you see that it's not in the act, so that one you can write for a private ruling to the Commissioner that this is what you want to do. You should give you interpretation whether that amount will be allowed as a deduction. If it will not be allowed as a deduction, then you stop.
Or you do it at your own risk.
You do it and it will be disallowed. That's it. So have you seen the difference?
Yes.
Now go to the section 100 and mention the worldwide cause.
The following causes are worthwhile causes approved by the government. A charitable organization.
And we have seen what a charitable organization is.
A scheme of scholarship for an academic,
So scholarship, education.
technical, professional, or an other cause of study. C. Development of any rural area.
So rural community development.
D. Sports development. Or
So sports.
promotion. And E. Any other worthwhile cause approved by the
Commissioner. So please note these things. We can ask you to write on them. We can also fix them in corporate income tabulation, and we will need better results. Please, Mr. Nguyen, you can do it. Was my number is what many other. Okay, so back to the question. What happened? Donation to. So is it worldwide cause?
No,
Allowable or not allowable?
not allowed.
Okay, continue.
Okay, so the next one is
The amount refers
the
to
additional tax paid during the course of the year. The accountant has
Provisional tax paid. So the person might have some taxes paid in advance, because this is the issue. They pay taxes on installments. They pay taxes on installments. So what happens is that if you have made a provisional tax payment, was it deducted as an expenditure?
yes.
Was it deducted as an expenditure? Then what you do is that you will disallow it, because taxes paid under the Act are not allowable deductions. Excluded expenditure, fines, taxes paid under the Act, bribery and corruption one are excluded. Domestic expenditure, personal expenditure are considered domestic. Disallow them. Then, because it's a tax paid in advance, if it is confirmed, then what the commissioner will do is that after you have determined their tax payable, you deduct that amount to reduce their tax liability. That is what we do. So are we good to go now? We now know which of the deductions can go into capital allowance, don't we? Okay. So quickly we work on this one. The apportionment. I think we were only doing for this. I asked you to do for this time add the 15,000. So 15,000 plus that one. So we will have fees and interest, and that will be the total should give us
1,250.
71,250. Okay. So we take 71,250 divided by 720,000. How do you get? I want the factor. You put the factor down. Yes, I bet you. The factor is 71,250 divided by 720,000. The factor 0.098.
How many decimal places?
Put it 4 so that
0.0989. That's
0.099.
or you want all the decimal places. You bet you. Opening okay, the one is here. Multiply by 70,000. Six 6927 .0, and then you approximate this one. So take 0.0989 and multiply by 70,000. Is the question asks us to approximate or what? How do you get
6923.
6923? Let me read the 692. Put it to the nearest hundred, thousands. 6923. 6923. Now, it's about more than 690 point. So now, person will confirm when you mean
0.099.
0.099. No. 0.0989. And what?
But there's 5 after the 9. There's 5.
So 0.099.
0.989558.
8.
First here. Yeah, I want to do away with the
6927.
6927. So you take this one, multiply by each. Yes. This is the factor. So this one times 100,000. This factor times 250. This factor times 300,000.
So 9896. 100,000.
This one.
Yeah, 9896.
9896.
24740.
24740.
29688. 688.
688. What's that? 300,000 times this one.
29688.
688.
88. Yes, sir.
Represent. Has a loss one means. That's a 250 crown.
Okay, okay.
Then this one was 6.
927.
So add or if it's up. A brochure
Also
there.
one. Also
A
one.
brochure we reconcile from the place. In the add it. Say I had, I'll put this one at 6. 9896 24740 296.
Also one.
A brochure one. So we quickly come here, addition. Addition. So the showroom is under construction. So addition. So the showroom, the cost, 100,000 plus this one, and that will be 1,798,96. So we do the rest. And the PM total was
274, 740,
and you add the
274, 740,
the next one,
329,
and the last one.
76, 926. 76, 926. 36.
Okay. So please, this is just a demonstration. What will happen on the faithful day, we don't know, but I know that if we practice well, there will not be any problem. And the main issue here was on the interest. Because when you read section 10, it says any interest that you acquire on debt is allowable deduction. So what somebody will say is, then I'm going to charge 2021. The person was to pay interest per annum of this amount. But this one, the person had not been in business. So they did not pay, so 2021, I'll charge all of them. No. Before commercial operation, there were no revenue, no sales were made. So the interest part should be capitalized. How do you capitalize it? The loan was used to acquire assets. So apportion the interest to the assets, and that is what we have done here. So now we can come back to our addition. The plant and machinery goes to which class? Plant and machinery used in manufacturing.
Class 2.
Class 2. So class 2, you will have addition, so no cost. But we have addition of how much? 27. The way we were allowing and disallowing, there was something on 13,000. That they charge some 15,000 and 13,000 on solar panels or what. So that one will form part of the showroom cost. The depreciable asset, raw material, is it a depreciable asset? No. So it will not come under capital allowance. You will grant it as allowable deduction. So remember, in the cost of sales also. It says this does not include
Initial raw material.
initial raw material. So this must be allowable. And now it is this one. Then motor vehicle. It's which class? Motor vehicle, which class? Class 2. We'll put that one to as part, motor vehicle. Class 2. Motor vehicle. I think I mentioned this when we were looking at depreciation, that if you have any motor vehicle which is not for commercial purpose, then the cost should not exceed 750,000 for it to be granted a capital allowance. Number one. They can, because it is coming because I saw 70,000 and I'm 76. I was thinking whether it was 75,000. Is it 750? Is it 75,000?
I should know it's 75,000.
Confirm. Because if it's 75,000, this 750 or 75. Yes, okay, I'll be ready. I wouldn't even find a capital allowance. $750 or 75. $75,000. The cost base of the road vehicle other than commercial vehicle should not exceed 75,000. $75,000. And this is what? 76,000. So for it to be granted capital allowance,
But this one is commercial vehicles.
is it commercial?
Yes,
Is it commercial?
yes, it's commercial vehicle.
Procurement of commercial vehicles.
Is it commercial? Okay. So they made the job very simple for you. Maybe I will not be in the position to make it simple for you.
You make it
Non-commercial. Okay, so now, so class 2, we can have another addition. Another addition for 76,926. Or you can put them together because it's in the same year that they were apart. They maintain the same. So 76, that will also be added. I think that is all. This one, please, the showroom. They said they use it for construction, isn't it? So because it's construction of showroom, it is under construction, work in progress. So it does not or has not been put to use. Are you getting it? It has not been put to use. Capital allowance is granted when the depreciable asset is put into use. If it is used in the generating of what? Income of the business. So if you don't put it here, I don't have problem. If you put it here and then you go and depreciate or grant capital allowance, that is a problem. So if it's not here, it's no problem. But if you put it there, then you only say maybe work in progress. Then you show the showroom amount 109.
896.
896. Then come and add what you disallow.
13,000.
13,000 something. You come and add it, but you don't grant capital allowance because it is a work in progress.
13,600.
So if it's not on mine and you go and see it somewhere, don't say it's wrong. Because I don't want you to go and compute 10% on it and add to your capital allowance. Because immediately you see it as showroom, you see it as a building, and you are tempted to work 10% on it.
The initial payroll software license.
Initial
Payroll software license.
payroll software
Because
license.
of the staff work for the notes on it.
It should be disallowed. Initial payroll software license. Initial, how much is it?
14,000.
So it comes under data handling. Payroll software was installed on the PC. Don't go and grant it useful life there. Amount useful life. Check on my useful life there, then you put it in class 5. But because the useful life is not given, add it to computers. So that is 14,000 will also come addition. JBA Yamia Kamesa disposal. Kesa will try BBA. But this one there were no disposals. So that's think, are we okay now? You are okay. Me, I'm not okay because I've forgotten what we disallowed and they were of capital nature and depreciable assets. If we have covered all of them, then it's fine. So we put the total.
Right, the vehicle tracking equipment as part of the motor vehicle expenses.
Motor vehicle
Yes.
expenses. Yeah.
Vehicle tracking equipment.
How much is it?
30,000.
Vehicle tracking equipment. If we expense it, class 2, will come under class 2. I don't know the nature of it.
Auto track is like an accessory to enhance the car. It's not a capital need, so you can expect it.
But it lasts beyond a year.
Yes, but looking at it's not material. As in the
Can it spoil any moment?
yes, for that one.
That is 30,000.
No, me, I'm not looking at the quantum.
But in real life, the cost of a vehicle is 100,000. But the tracking device will not even be up to 5,000.
But this one is 30,000.
No, I'm just in real life. That's what I'm trying to say. It's an accessory, just like buying a tape into the car.
So it can be expensive. Okay. Expensive. Let's make it 2 times.
First, I need 4,000 to 1 and 4,000. From 2, where is your
At least if you get 2 wrongs, I say nothing.
You gave me 50.
50 penny and I'm sure, yeah.
I got it.
Pool 1 is 94,000. Pool 2.
We have 301,666.
301,666. Pool 3.
65,000.
Pool 4.
270,000.
Work in progress.
But it will not be added to the calculation of the capital allowance.
Why? That's the examiner that's all take care of it.
Total.
But the one fan come on, meaning how they will take, but once you are able to show say the total is this, it's okay. Then charge capital allowance on each.
The first one, the main 4,000.
So depreciable base. You said this is 94,000.
Yeah, that's
So you work 40% of 94.
37,600.
Then the written down value will be the difference. You subtract this from it.
We put 13,000.
30.
For 27,000.
Class 4. Then work in progress.
This another the general expenses, the architect's fee for the factory building plan.
Factory building plan. Is it part of factory building? That is their showroom or?
Architect's fee for the factory building plan. Looking at the access very this time, there was factory building.
So assuming, and they came here and they said they deducted. Masa, allow. Because the building plan, it should be disallowed. You disallow the building plan. And when you disallow, we assume that it's part of, that is the assumption I think the examiners will make, that is part of the cost. Because I don't know what went into the cost of the factory building. I getting it. But it's better you disallow it here. Disallow it. Don't grant it. You disallow it as to whether if it is part of the cost or not. We have capitalized the factory building. So maybe that amount is part of the 270,000. That one, I don't have the details. So if in practice you have the details of what went into the headquarters building and the building plan permit or whatever is not part of it, then you bring it there. The total for this is
I've computed the listing.
301 666.
Maybe I've computed the capital allowance and got 125,500.
how did you get this?
No, after getting, I guess, multiply
So
by
1
05500.
Then calculate your
10
550. Where is 274, 740 plus 7 C's?
926.
What I got?
It's
96 or
269.
This is 76.
76.
Yes.
Then it's 3, 5, 6,
3.
And the total is
30% is 105500.
So you now add all of them total. I think this is the highest level of capital allowance computation examined in level 3. And it is all about the apportionment that
So, say every sitting, there's a question on capital allowance.
that one I'm not sure.
There is a question of corporate.
There is a question on taxation of business income. And traditionally, it has been question 4. So, question 1, I want to say, swimming cassette, question number, question number. But each sitting, you have a question on corporate business income taxation. So, the total capital allowance is please remember you will not work capital allowance on the work in progress on the showroom.
183,100.
So total 183. So that will allow us a deduction. Master, the architect, AC can be
10,000.
10,000. It was treated. The 270, was it building or what?
270.
At costing.
Head office building was 150,000. Factory building was 120,000.
So we put the two together. So add the addition, the building plan 10,000. So the building plan 10,000 will come. Then this will be 80. So this will be 8. And this will be 4. Okay. Thank you very much for helping all of us.
Are we close?
No. I'm making my remarks on this one. So what you are going to do now is the B part. And that was what I did. Yes. So what you do is that you take the net profit, then you adjust with what we indicated as allowable, non-allowable. All the non-allowables, disallow them. All allowables, like this one, you deduct and you get your chargeable income. So do that one quickly. Oh, yeah, I say. Me check a platform, so crana, almost open chassis, so do that one.
So that total chargeable income, we calculate 25% on it. And after getting the chargeable,
Adjust them, you do the adjustment. Please take note of, you mentioned a tax that was deducted. So take note of it. Those who will be watching on this, they will not see the name way well. So you screenshot them and snap the date from here and post them on the platform so that when they are watching the video, they can look at it.
Are you using the one after tax or before tax?
The net profit. If you use after tax, you will know how to adjust it. If you use before tax, you know how to adjust it. I don't know what was the last deduction.
Corporate tax.
So corporate tax, if I am using after tax net profit, then I know that corporate tax is not allowable. So I have to add it back. Somebody will say, oh, then for me I'm using before tax. If you are using before tax, then don't come and add back the corporate income tax. Are you getting it? So it depends on which one you go back.
It's not really direct. Yeah.
No, so screenshot it and post on
my phone is not connected.
the platform. Post on the advanced tax platform. So that when the person is watching the
I'll open
video,
the iPhone.
the online people,
I don't like online.
so this will be your working. So you do the workings at the far page of your distance. Question paper.
I was saying, when you're live or recording,
So you snap and post on the platform. So this is what you do. We open the B part is what? STE Limited. Computation of chargeable income for computation of chargeable income for
The year ended
2021 or 2021 year of assessment, basis period, this one. Then you come, net, I said somebody could use net profit after tax, another could use net profit before tax. So if you are using net profit before tax, then you write add back. Then you leave about 10 or 20, 15 lines in between. It's about time. I will pay 50 marks, 51 marks there. What they sorry. So net profit, what put you away? I said, me ye my father, she said, one of the cause, young quiet, allow, now they are shall not allow. My ears are dealing in Adam. It's me, Baby, through her, my sister. So net profit before tax, then add back. Number 15 lines, add to. No back, less, at all. Now you go through the ones you wrote add and non-allowed. It means you are adding them back. Then come and list them. So have you taken the screenshots?
Sure.
So I'm not going to do any workings again. So quickly, is there workings? Because we've done all the workings. So B, STE Limited, computation of chargeable income for 2021 year of assessment. Net profit. So basis period can come, basis period. Net profit before tax. How much is it? The currency is needed. Net profit before tax.
272,154.
And what was the net profit after tax?
247,691.
I want the before tax.
272,154.
542. Add back. Then less. The first less I will have is my capital allowance of how much?
1,841.
184. is lying there. If they say stop work, I have a tick. Then is there depreciation?
Sure.
That is something to be added back. Depreciation.
32, 250.
32. So I have disallowed depreciation and then granted capital allowance. We also disallowed some family issues. We disallowed business plan, architect plan. We also disallowed
Penalty for late pay as you go.
so showroom 13,640. What was disallowed here? Then architect plan also of 10,000 Indian kind. Then this one 14,000, which was initial plan for pills again. Or OPSA now I share category. So utility now they have the number and some about the all this allowed and also a money effect. I mean the time into the disallowing. Any other? Family and friends. Mm-hmm. 2,000, 3,800.
Penalty for late pay.
Okay. Penalty. Late PAYE. How much?
5,000.
Installation of, I think it's here.
And of the party, staff and labor.
Staff, Staff.
Marketing director's family of 3,800.
Staff party was allowed.
3,800.
in 2% frank, I also watch staff salary and gain area and some waba family and friends figure. And then you can tell.
Donation to political.
Yes,
3,000.
donation to political party.
3,000.
Is that all? Interest of how much? Is it allowable or non-allowable? The interest, was it allowable or non-allowable?
Interest to your account is allowed.
Interest to so the person took a loan. How much interest was charged? Did they charge more than 112 something?
That's the problem.
Is that all? Do you have PAY 5,000?
Yes.
initial payroll 14,000.
Yes.
Family and friends entertainment 3,800. Then the utility is 13,640.
Yes.
You have the building plan.
Yes.
You also have political party,
Yes.
then depreciation.
Yes.
But you don't have something which I have not mentioned yet. And do you have end of year party?
The staff end of year party.
Is it allowable or non-allowable?
Staff tea and refreshment.
Staff end of year party. Is it allowable or non-allowable? But did you mention it here? So end of year party. End of year party. How much?
7,350.
Then the interest that was paid.
Please with that one, I thought the area expenditure, if they all enjoy it, then
It's not about if they all enjoy. The issue is this: welfare canteen. If it's available to all the workers, then that one you allow for canteen. But this is a package that you are giving at the end of year. The best thing is that in order for you to be granted a deduction on that, add it to the employees package, their pay emolument, so that they will pay the tax and you will get it as a deduction. Because utia staff wages, say I grant you, until they find the same way, you be granted the amount. The tax burden will go to the staff. But here's the case: you do not do it that way. Then you package the rice and then the Milo, everything, and then you give it to them, and you want to charge it against your profit. No, it will not be done. So that was what happened here. End of year party for the staff. If you want to avoid that, pass it through their pay, and they will pay the tax on it, and you will enjoy your deduction.
And those monies from for the end of the party is from the staff welfare.
It's for staff work.
From the staff welfare. Money is meant for the end of the party from the staff welfare.
I don't get you. Is it that the organization had a welfare, and the organization, they contribute towards that and run party at the end of the year? So the money was paid from the welfare. If that is the case, Krana, you cannot come and deduct it here. What do you know, Krana, West Krana? Because the welfare is independent of the company. How I call Didi? No, I mean, oh, what do you know, Krana is disallowed. Let's disallow it. The interest. How much was deducted? The total interest that was deducted per the account was the interest deducted on the account.
183,750.
183,750. They deducted this whole amount, 183, which is made up of, they gave the breakdown as
2% non-establishment fee
of 15,000. Then
2020 interest paid
2020 interest of
56,250.
56,250.
2021 interest paid of 112,500.
2021 112,500. So this 2021 listing is allowed, but this one is not related to 2021. That is why we included them in the cost of the assets acquired in 2021 and granted capital allowance on them. So what we do is that we have to disallow this portion. We put the two together. And it's 71, 250. So that interest portion will be disallowed. Your interest. 71, 250. I think that was added to cost wave. One, two, three, four, five, six, seven, 8, 9, 3. Then what again should be added here and deducted, less the deductions. What do we have? The raw materials. The cost of the raw materials. Now we're done. From the workings. How much was it? It was 3 something.
329,688.
Have we added the interest and fee component?
329,688.
329,688. What again needs to be deducted? Apart from these two.
Salaries
Salaries and wages on teaching from Dana. What the net profit in your various accounts in the because salaries and wages who are interested in
The raw materials.
The loan that they took was used to acquire raw materials, 300,000, and then the interest component will also be added. Where we did the apportionment. Two person who will show workings. Now we'll show working number. Attaching the hand. Na exam na them say, oh boy, you know, to the audience. Who think around old child?
The note 9. The amount refers to the provisional tax paid during the course of the year. The accountant had projected the taxable income for the year ended 31st December as 950,000.
The accountant's projection was 950,000. Then go to that deduction which relates to that. I remember that note.
The corporate tax paid.
Corporate tax paid. So estimated. Then They said they have paid how much?
244
244
625.
625. So actual. And out if you come estimate in your lower. Now we mean to know where your friend says. IS 12. Aha, and there you are. The United said this tax should not be deducted as an expenditure. What you do is that it must be disallowed. By you disallowing it, you started with profit before tax. So you will not, all it means is that that 244 already has not been what? Deducted. So when you know what happened. But there are no point profit, net profit after tax. Or no the end of the Kaubaha. A becan be becan is hard back. What is that? It was your own chess. I would be so air bad. Oh, yeah, the idea I would be a accountant in the pay. But you are a tax consultant, and you have about when you said, Sherman said, yeah, GR for DD, the woman. It won't sound about my team, as I would mean and Brahmi, because excluded expenditure, fines, taxes paid under the Act are not deductible. The last one, they made a refund. GRA refunded an amount in the form of VAT. Is it on the listing note or in the question? That there was 11,000. Any note to it? So you deduct that one. Because maybe they are running what is called VAT system input and then output. So the difference show that they have to be deducted that amount. So the VAT refund, consider that one. We will finish with the chargeable income. Because what happens is this: when you are running a VAT system, we have the input VAT, then you have the output VAT. So if your input VAT is maybe 10,000 and your output VAT is 9,000, your output is this, your input is that. The difference, you have net VAT of 1,000. So what is happening is that the person has to refund that amount, 11,000, and that is why it must be a deduction, because already the person has included in his or her sales, the sales figure there. Their VAT of 11,000 was considered part of the sales. So if the person is to refund, then we have to deduct it from his income. So we take VAT of 11,000 in addition. So total all these and come and add it. Then total all these and come and then subtract. And that will be your chargeable income. But we were reading somewhere and they said it was an advanced tax pay.
The amount refers to the provisional tax pay.
Provisional tax pay.
The accountants have projected the tax income for the year ended 31st December 2021.
So this is, it means who apply IS over provision. The total addition or add back 16290.
160.
160,296. Then this one. Then 3. 524. So this plus this minus this. Two. And take 25% of it as the taxpayer. So 25% of it,
589,261.
and that would be the tax payout. So the one who headed this thing as chargeable income. So when you finish, you come and write computation of tax payout. Then you come and take tax payable 25% of the chargeable. So the best thing is that you would have added this one as computation of tax payout. So that when we are looking for chargeable income, it is there. So please, Mama V is very simple. Mama V doesn't have any capital allowance to be computed. So you work Mama V.
So with this question, there is no limit on the
Finance cost. The limit on finance cost, I have seen it.
There's a
here.
question
In that year,
yeah.
I have seen it. So that is what I might leave you to discuss. Oh, yeah, I said take the 20, In that same year, question number 3. Yes, question 3. Let's look at that one quickly.
December.
There is a finance cost. Conti Limited.
Has been in the buy and sell basket business for some time now. Conti Limited basis period is January to December each year. The chargeable income of Conti Limited.
Please, this is what we do. I will not read them. But as we read, anything allowed, I'm not printing wrong. That can watch wrong. Disallowed or something. Disallowed or something. Okay, let's read.
Okay. The chargeable income of Conti Limited for 2021 year of assessment is 7 million GHC.
So chargeable income per their account is 7 million. Not what you, the tax expert, you have done. What you have done is what we call the adjusted chargeable income. Continue.
The chargeable income was arrived at taking into account the following.
So before they had that 7 million, these were what went into it.
An amount of 200,000 was spent on staff lunch, with evidence on how much each benefited. The staff were not affected by this payment according to the management of the company.
So what does it mean? Let's read that one quickly.
So you add it back.
You add it back. Even though it was available to all of them, the last part is bringing
The
about
staff
the
were not affected by this payment.
So if they were affected, then you would have allowed it. The affection here is that they did not include it in their what? Payroll.
So we've added into a 7 million and gotten 7.2.
So add back.
Yes.
Again the same. Have you captured this one? Umajuma so.
Who captured the first one? It's clear.
Look back this one. Okay. 2. Financial cost for.
So it says there was a chargeable income. The company is Conti Limited. Chargeable
Compute the taxpayer.
income. Computation of tax payable for 20, which year of assessment?
Just open. It's an open account, no year of assessment.
January to December.
Year.
No. Read no. Read the question.
21 year of assessment.
21
2021 year of assessment. So basis period.
January to December.
There was a chargeable income of how much? The currency is CD or Ghana cedi?
Ghana cedi.
700,000.
7 million.
So if they were preparing a counter, it would have been the opposite. And it being in an account. This one, they did not give you the extract. If it was the extract, this wouldn't have been the 7 million. Continue.
An amount of 200,000 was spent on staff lunch with evidence on how it was affected. The staff were not affected by this payment according to the management of the company.
Staff lunch, how much?
200,000.
200,000.
2. Financial cost for derivatives was 20 million.
Financial cost, 20,000 or million?
20 million.
20 million.
Financial gain from swaps arrangement was 1 million.
Financial gain,
1 million.
1 million.
Goods amounting to 12 million were invoiced to another company in controlled relationship.
Goods, please, I'm interested here. Goods invoice to another company in controlled relation. So I will say invoice to a parent, invoice to an associate. What comes to mind? Any trade between them should be at arm's length. And therefore, if it is not at arm's length, you have to adjust it to reflect arm's length. So invoice, read the question now.
Goods amounting to 12 million were invoiced to another company in controlled relationship. Such goods in the hands of uncontrolled persons.
So in the hands of uncontrolled, so third party, it would have been
13,130,000 Ghana cedi.
this. But between related parties, it was
12 million.
So what is the difference?
Difference is 1130. 1,130,000.
1,130,000.
130,000.
So goods invoiced. So what it means is that they made the sales, isn't it? And the sales has been reduced by this amount. So what do you do? Bad mark. Continue.
Okay, so from the scrutiny of the accounts of the company, the following additional information is made. Interest on loan amounting to 3,200,000 was added to the financial.
Interest on loan. Interest on loan was
3.2 was added to the financial cost above.
3,200,000 was added to the financial cost here.
Yeah, that's 20 million.
So the actual financial cost will be
Less than
minus 3,200,000.
6 8.
There's an additional listing.
The information TV.
Okay. 80% of the interest related capital work in progress.
Please, Take it again. This interest.
Interest on loan amounting to 3.2 was added to the financial cost above.
Okay.
80% of the interest, that
So
is
80%. So find 80% of 3.2.
256, 2.5 minutes,
2.
2,560,000.
This.
Yes, it is. 80% of the interest relates to capital work in progress. And the
Relates
rest
to capital. So 80% of this interest, which is this one, relates to capital
work in progress.
work in progress. That is a showroom.
And the rest to support working capital.
The rest to support working capital. So the rest is allowable deduction, but this one is non-allowable. That is what the person wants you to know. Continue.
The capital work in progress will come on stream in the next 5 years.
The capital work in progress will
Come on stream in the next 5 years.
this one
Yes.
will come.
On stream in the next 5 years.
So if even we are going to charge something, then it should be having a useful life for 5 years. But until 5 years, it has not been put to what use. So all is to help you to disallow this portion.
So the 20% is 640,000.
That one is not interested to me. Because it's the 80% that has a problem, not the 20. The 20 is allowable. That is the interest in connection to the raw materials we use. It's allowable. Continue.
An amount of 500,000 was received as net dividend from Unlimited, a resident entity, where Kunti Limited owes 24% voting power.
An amount of
500,000
500,000
was received as net dividends from Unlimited, a resident entity, where Kunti Limited owes 24%.
an amount of
500,000
500,000 as
was received as net dividend from
net dividend
Unlimited.
from Anne.
Yes, sir.
And who is Anne? Is it resident or non-resident?
Resident entity.
Resident
Entity.
entity.
Where Kunti Limited
Kunti holds
24%.
24%. Please,
This amount was added to revenue.
it was added
Revenue.
and added to revenue. And we'll talk about it. Continue.
I'm done. Compute the taxpayer.
You are done computing. Okay, that is a very nice question. Okay, so we are saying that the chargeable income was arrived at. I wanted to get the extract before they had this one, but looking at baby or demanding now. That's a matter. So I wanted to see how they came about this. So this one is in wedding form. So finance gain. And they had some dividend. Dividend was also added. How much was the dividend? This net dividend from 500,000 was added. So from your readings, what it means is that there should be revenue. So this is what I want you to do. 506 million or 600,000 minus 200,000 minus 20,000. What do you get? 500, 100 plus the two are added. 600. Then add less 200. Less 20 million.
Negative 19,600.
Negative 19,600. Then what it means is that this one x minus this is giving me 700. So x minus this is 700. X is equal to
12,600.
so add subtract 700 from
12,600.
You subtract 700 from what you do is 700.
It's 7
Add a
million.
positive figure.
It's 7 million.
7 million. Is it 7 million or 7? The chargeable income.
7 million. 7 million.
How much of 700? With what we say 7 million. Okay, 7 million. So what I want you to do is this. That's 7 million plus the figure you had, not negative, positive. When you are 19 minus 19, minus 19, into 19, and you know without the minus,
600.
what did 7 million have? So the revenue was 26,600.
600.
Million.
Sure.
Say.
Yes.
Nti sɛnka account yɛamfa amma wo statement a kɛse na revenue na wɔn dividend this amount, finance gain this amount, na wɔasan aseɛ ɔsɛ total income. Ɔka mo ma yɛ sɛn 20 7,200. No, but less we. Why doesn't? What do we move?
7 million.
We're not 7. The extra saying I'm the development. And sana waba additional information. The additional information will read with. It will read with. No, it will read with anyway. Additional information. Remember, I have me delay mawa, me delay count one. And your question be now the person may be sound on this 24%. Taxation of shareholders. Let's write that one quickly. taxation of shareholders. And sana yabesolve question. Taxation of shareholders. Corporate entities are taxed separately from their shareholders. And I assure that corporate entities are taxed separately from their shareholders. A return from their shareholders. Okay, are taxed separately from their shareholders. First of all, corporate entities pay tax at. It's okay, I'll come there. Corporate entities pay tax at 25%. Whilst shareholders, whilst a return to shareholders for equity investment, is taxed at 8%. As dividend on a final withholding. Under certain conditions. So what are the conditions? What we are saying is that if you are a shareholder, you are taxed separately from your company. The company will be paying tax at 25%. You, the shareholder, once you have made investment in the company in the form of equity. I remember last sitting, they asked them, what is the implication if they make the person releases an asset to them or he gives them a loan? If you give them an asset, then you are making investment in the company. So for you, you will be enjoying dividend. When you enjoy dividend, we will tax you at 8%. Then if you try to give them a loan, then you become a debtor to them. So for you, you will not get dividend. What you will get is interest. So when the company pays you interest, Section 10 says it is allowable deduction, provided that the entity's capital does not exceed 3:1, 10 capitalization. So if you give it as an asset, the entity has a benefit to deduct that interest as a deduction. It will reduce their tax liability. But if you give it as equity, then for equity, it is when we make a distribution. If we are making distribution, the dividend is not allowed as a deduction. As I'm saying, simple as you have to apply. That is why we say your main work is to advise. So I want to go into investment. I have the option to provide it as equity investment, or I provide it as debt. If I go to debt, then the company will be paying me interest as my return. But that interest, the company has the right to deduct it as allowance Because of that, the liability of the company will reduce. But if I provide it as equity and pay you dividend, the company will not deduct that dividend as an allowed expenditure. So because of that, their tax liability is going to be higher. So they ask you to advise which option is good for tax. Then it's better you go for what? The debt, so that I will have the interest deducted and it will reduce my liability. So that is what I'm saying. Companies are taxed separate from their shareholders. Shareholders, if they are equity holders, they will be getting dividend. If they get this dividend, withhold tax at 8% on certain conditions. One, that the dividend is paid by a non-resident entity. The dividend is paid by a non-resident entity. So a non-resident entity paid you the dividend. You are resident. A non-resident entity has paid you dividend. It must suffer withholding tax. That is the first principle. Then the second principle B, that the dividend was paid by a resident entity, was paid by a resident entity which has engaged in petroleum or mining. In petroleum or mining. So here what it means is that the entity from which you are receiving that dividend is a mining entity, or that entity is not a mining company but has engaged in mining activity, and that is why the person is giving you dividend. That one you must suffer 8% withholding tax, and that should be a final withholding tax. Okay, the next one, the withholding tax is exempt where the entity receiving the dividend has at least 25%, interest in the entity paying the dividend. So what is the difference here now?
If the receiving entity has between 25 to 50, or about 24, then they are not going to pay that 8%.
That is when you have two resident entities. One is paying the other dividend, and the other holds at least 25%. Then that income, that dividend is exempt from tax. So it means that your 8% number can so and please, are you okay? So the questions that they are likely to ask you in exams is that under what condition is dividend exempt? One put in a simple term now. He holds interest in ANN Limited, which is a resident entity, but only 24%. Because of that, this dividend must suffer withholding tax. They are both residents, but if I should hold 25%, then that 8% will not be withheld by ANN. So what advice would you give to Conti? The best thing is that Conti should increase his investment by 1% so that he can avoid that 8% and receive the gross amount of dividend from ANN. But if Conti continues to hold 24%, you will continue to pay the suffer 8%. So the best thing is that Conti should increase the investment in ANN. That is tax planning. Or if Conti wants to continue to be paying the 8, then fine. The next thing is that assuming ANN is resident, but ANN is into petroleum. ANN is into petroleum. Then under that situation, whether you Conti holds 50, 100%, it will still suffer what? The 8% withholding. Are we okay? Then the next one, C. An entity who invests in a free zone, enterprise is exempt from dividend withholding tax. So they will ask you which of these companies should you invest in. Free zone. Entity A is in free zone. Entity B is in manufacturing but not in free zone. So if you make investment in any entity that is in a free zone and they declare dividend, you are not going to suffer the 8%, provided the dividend is coming from free zone activity. Are we okay? So that is taxation of shareholders. Shareholders are taxed independent from their companies. In that, if you go into free zone, if you go into invest in a free zone, then free zone, you the investor, you are not going to pay any dividend tax. If you go into investment in any resident entity, and that resident entity you owe or control directly or indirectly 25% of the voting rights in that entity, you are also exempt from that 8% withholding. But if your investment is in petroleum or an entity which is resident and has engaged in mining or petroleum operation, then for you, you have to suffer. You again suffer if your investment is less than 25% in any entity, resident entity, But if it is from non-resident, yeah, you are taxed. Are we okay? Are we okay? So in this case, they have 25%, 24%. They were paid dividend 500, and they added the 500 to income. So this is the extract. And they say additional information goes invoice to a third party for 130 was given to a controlled person for 12,000. So there is an undercast in revenue or sales. Related parties should trade at arm's length. It was not at arm's length. So that's undercast. What do? You add back. Then the person has finance cost. Finance cost of 20 million. Deducted this finance cost 20 million. That was what the person did. But per investigation, we saw that 3.2 million was paid on interest on loan. Interest on loan. Please, this finance cost that is deducted here should not include interest. So immediately interest is included here, then you have to separate them. So that is why 3.2 minus from the 20 million. When you take the difference, it is what? 6,500,000. True or false? 20 million minus 3.2.
60 million, 800.
60 million.
800. 60 million,
800. So this should be the finance cost. The finance cost is the cost you incur in acquiring a financial instrument or a derivative, not the interest you are paying on loan. So it must be isolated, separated. Then with this interest, it says there was a capital aspect of 80%, and again the 20% was on the raw material towards work in progress. So the work in progress will be allowed, but the capital nature will be disallowed. How do you disallow? Since it was included, deducted, so add it back. What is not deducted, you go and then deduct. So now I think the explanations are okay, and how they should be subject to tax. Dividend. Immediately you see this dividend, what comes to mind? A final withholding tax. It should not form part of what? Revenue or your income, because it has suffered a final withholding tax. So what do you do? It was added. What do you do? Less. So chargeable income, 7 million. Then all those that were disallowed, add back. What do we add back? There was a lunch, but final evidence indicated that they were not what? The employees were not affected. So because of that, add back the lunch. 200,000. Was there any depreciation? No. Then they deducted a finance cost So you add back financial cost. How much was deducted?
20 million.
So all the 20 million will be added back. Add back all the 20 million. Now within that there was 3.2. There was 3.2 as interest. As interest. Which is part of this. So what we can do here is that the whole 3.2 will be deducted because we only want to. The interest part is allowable. The interest part is allowable deduction. But the problem that came, please take note of the way they treated the 220 million. This was captioned as finance cost. So with this, if the entire amount was the finance cost, we will add all back here. But he says that from this, there was interest. Interest of how much?
3.2.
So when we deduct the interest,
16.
you have 16,800 as actual finance cost, excluding the interest, because this interest is allowable. But the problem with this interest is that the question again went on to tell us that there was a capital portion and then interest related to working capital. So about the STE, you saw that there was interest on raw materials and only and working capital. Then there was interest on the showroom, that is capital interest. So all of them will all go to one place. This will go to P&L, income statement. That one goes to balance sheet because it must be part of what? The cost of the asset. So with this, 80% of 2 million.
256.
256.
2.560. Yes.
Then the remaining will be
640.
640. So finance cost, this was added, but finance cost in the average Bako Mienu Miensa. Bako Mienu Miensa. We is not allowed. We ain't allowed. So how can you treat this? There's two ways. Whether you deduct all the 20 million here, and then this was deducted. So you come and add it back. Are you getting it? Then this was allowed as a deduction. I will not do anything about it. The effect will be the same. Somebody will do it this way. I'll take the 20 million, deduct the interest, or so that I have 20 million minus the 3.2 million. And the person will have 168 16 800 million. When the person does it this way, then what is left will be the treatment of this 3.2 million that was deducted. It means this amount is still deducted, the 3.2 million. So I add back the 5.2. So add the interest on capital expenditure. I'll add it back at 2,560. Then I come to the less. It means that I've done away with the whole distance. So less the gain was 1 million. The gain of 1 million. Finance gain. Then dividend. We said that dividend suffers what? A final withholding. And the person has added. So you have to do away with it. So added there to do away, what do you do? So less the dividend. Of 500,000. Then the overcast, undercast, what do you do? Arm's length. So arm's length, undercast of sales or invoice. Somebody will want to know how we had it. 1, 3, 0. Then finally we left with the 20% interest. So interest, that one is allowed. But what I did was I subtracted the entire 3.2 so that I can separate them into allowable portion and then the non-allowable, and then the allowable portion. So interest, 20% interest on working capital. And that is 640,000. Now we do the summation and then the subtractions. to then say different quantity.
So the addition,
When you add the 4, what do you get?
26,900,000.
20,
6,900,000.
690,000.
Yes.
Yes. The deductions.
$2,140,000.
2, 1,
40.
less that one. And what you get is what we call the adjusted chargeable income.
25. 550,000.
Adjusted chargeable income. It's time for you to compute the actual tax. This one you have made the adjustment to know the amount of tax and finance cost that should be deducted. So how do we do that? It says take finance cost limit. Finance cost limit. Financial cost limit. Please, the financial cost should not include interest. Financial cost other than interest. So don't go and take the 20 million to look at the limit. Take excluding interest. So financial cost limit, it says that 50% of adjusted chargeable income. What is the adjusted chargeable income? 255.
The 5 is 3 and 4 zeros.
Times 50%. What do you get?
12,775,000.
12,775,000. Then you add the finance gain. How how much was the gain on the financial instrument?
1 million.
1 million. So we come and add 1 million. The total is 13,775. So this is the limit. What it means is that we cannot deduct any financial cost which is more than 13,775. No financial cost can be deducted above this. So you look at the financial cost that was deducted. No financial cost should be more than the 13,775. If what was deducted, how much was the financial cost? 16,800. Is it in excess of 13?
Yes.
So what it means is that from the 16,800, 13,755 will be deducted as allowable finance cost, and the remaining will be carried forward for the next 7 years to be charged against future cost or gains or limits. So we now compute the actual tax. So tax, computation of tax payout. We take our chargeable income, adjust it. How much? 25,55,5,500.
The zeros are 4.
Then I said that this is where the finance cost was added. The finance gain was deducted. So what you now do is that you reverse what you did. So add the financial cost and gain. The gain was how much? 1 million. When we add the gain, we have 26,550. Then we now less. You don't less the finance gain, which is in excess, but rather finance cost limit. The limitation should be deducted, not the one in the question. So if it happens that you're in the question, the limit is smaller. The limit is smaller than what was deducted, like in this case, then we grant the least. If we worked and this one was 18 million and this is 16 million, then the 16 million will be deducted. So here the limit is 13,775 million. You less it, and you have chargeable income for tax purpose, which we pay tax payout at 25%. We subtract this from this. With this, we have covered everything under corporate income taxation, those wicked areas. I think, was it in July, sitting was on tin capitalization, the area was on tin capitalization. And this sitting finance cost limitation should also be practiced well. 50% of the chargeable income, adjusted chargeable income. So when you find the difference, you have the chargeable income of how much?
1,277,500.
1,277,500. So you work 25% of it.
3 million. 150,750.
So that would be the tax payout. Any question? please, in this question, the difficult thing was on this, the interest. The interest. The capital aspect and then the working capital aspect. Working capital aspect, interest should be deducted. Then the capital nature aspect qualifies for capital allowance. That is why you are allowed one and then disallowed the other. So you have Mama V. You also have July 2023. So that at least I'll know that Mama V is 2020. And then we did 2022. If you do 2023, when you job, when you can, and there are couple of homes. So question in my statement for and I made say extra format, same it's a very say on fact, some to the mouse dividend on campaign job, oh, she win. I also want a dividend, a final withholding. Continue. So please, I will end here for today. But you can do all the business questions from 2019 November. You try your hands on them. 2019 November up to July 2023. All the business questions. Practice them. You see that it is the same trend. The trend is the same. The trend is the same. They only change the wording. As I make way for one more one.
In August 2020, we are asked to complete the capital allowance.
We will start from 2019. If you now do the workings here, you share ideas and then do that. If you may need backup. Okay, we shall meet. Please take care of your destiny.